What caused FDIC insurance limits to change for banks? Imagine saving your money and feeling confident it's protected no matter what happens. That's what FDIC insurance aims to do. But have you ever wondered why those insurance limits keep changing? Well, let's explore what has driven those shifts over the years. When the FDIC was created in 1933, the insurance limit was just $2,500. Back then, that was enough to give depositors some peace of mind. But as time went on, that amount started to seem too small. People wanted more security for their savings, especially as the economy changed. So, in 1934, the limit was doubled to $5,000. As inflation took hold, the real value of that coverage shrank. To keep up, the limits were raised again. In 1950, the insurance coverage increased to $10,000, and by 1966, it was $15,000. These changes were based on data showing that higher limits would protect nearly all depositors during bank failures. Then came a big jump in 1980. The insurance limit was increased to $100,000. This was partly to help banks keep their depositors' trust during a time of high inflation and economic uncertainty. It also helped banks attract new funds and stay stable. The most recent major change happened during the financial crisis of 2008. After the failure of Washington Mutual, the largest bank failure in U.S. history at that time, the FDIC temporarily increased the insurance limit to $250,000 per depositor at each insured bank. This move was meant to restore confidence in the banking system during a period of widespread financial panic. In 2010, this higher limit was made permanent through the Dodd-Frank Wall Street Reform and Consumer Protection Act. This change reflected that the previous $100,000 limit was no longer enough to protect depositors, especially with rising inflation and larger deposits. Other factors that caused these changes include legislative actions to support specific accounts, like public deposits, and the need for banks to keep pace with modern banking practices. For seniors saving money, these updates mean their deposits are better protected now, up to $250,000 per depositor, per bank, in each ownership category. It's important to understand these limits so they can organize their savings wisely. Knowing the current insurance coverage helps seniors choose low-risk bank accounts that keep their money safe. In short, FDIC insurance limits have changed over time because of economic conditions like inflation, banking crises that shook public confidence, and laws designed to keep the financial system stable. These updates aim to protect depositors, including seniors, by adjusting coverage to match the realities of the economy.